The shock that most people think is only a geopolitical headline is not just a headline. It is a pressure wave moving through oil, inflation, interest rates, corporate earnings, household budgets, and ultimately the price of almost every asset people own. That is the part most investors miss. They see Iran, they see oil, they see a war risk, they see a scary chart on television, then they either panic or they try to guess the next headline. That is not how I think about it. When I look at an event like this, I do not ask, what is the news? I ask, what is the mechanism? What are the cause and effect relationships? Where does the pressure go next? Who is fragile? Who is strong? Who is forced to sell? Who has enough staying power to survive? And which companies become more important in a world that becomes more chaotic? The Iran shock, if it develops the way markets are starting to fear, is bigger than most people understand because it is not only about one country or one conflict, it is about energy, it is about inflation. It is about the Federal Reserve losing flexibility. It is about consumers being squeezed. It is about weak businesses being forced out. It is about strong businesses being marked down temporarily, even though their long-term earning power may still be intact. And if you do not understand that chain, you will probably do what most people do at exactly the wrong time. You will watch the market fall. You will feel pain. You will believe the headlines are the whole story, and you will sell good assets into fear. That is how portfolios are damaged. But a small minority of investors will see the same chaos differently. They will not see only danger. They will see a stress test. They will see a sorting machine. They will see the system separating weak companies from strong companies, crowded trades from durable businesses, emotional investors from disciplined investors. That is where the opportunity comes from. I am not saying that crisis is pleasant. It is not. I am not saying that losses do not hurt. They do. I am saying that history repeats because human nature repeats. And when fear becomes the dominant force in markets, prices often move much faster than fundamentals. When that happens, good businesses can be sold at prices that only appear for brief periods. That is why preparation matters. Right now, oil prices have been moving higher. When oil prices go higher, the cost of transportation goes higher, the cost of production goes higher, the cost of almost everything that moves through the economy goes higher. That creates inflationary pressure. Inflation is not just a number. It is a tax on purchasing power. It changes behavior. It makes families spend less. It makes companies protect margins. It makes central banks more cautious. It creates a conflict between growth and price stability. When oil pushes inflation higher, the central bank has a problem. If the economy weakens but inflation is still too high, the Federal Reserve cannot easily rescue markets by cutting rates aggressively. If it cuts too quickly, it risks feeding inflation. If it does not cut, the economy feels the pressure. That is the stagflation problem. You get weaker growth and higher prices at the same time. Employment weakens. Consumers feel poorer. Small businesses lose flexibility. Weak companies that depended on cheap capital, easy demand, or constant optimism begin to break. That is the environment investors are afraid of, and for good reason. But the important thing to understand is that markets have been through many versions of this before. The reason is different every time. Sometimes it is an oil shock. Sometimes it is a credit bubble. Sometimes it is a technology bubble. Sometimes it is a pandemic. Sometimes it is inflation. Sometimes it is war. The label changes, but the market cycle does not. Markets expand. People become confident. Confidence turns into excess. Excess creates fragility. A shock exposes the fragility. Prices fall. People panic. The system clears out the weak players. Strong companies survive. Then the next expansion begins. That is the basic pattern. It has happened again and again for more than a century. The investor who has never studied that pattern feels like each crisis is the end of the world. The investor who has studied it understands that a crisis is both a danger and a reallocation of future returns. That difference is everything. A crash does not automatically scare thoughtful investors. A crash makes them ask better questions. What should I not own? What do I want to own for the next 10 years? What will the world still need when the panic is over? Which companies have the balance sheets, margins, market positions, and strategic importance to survive the stress and come out stronger? Which assets are merely popular and which assets are structurally necessary? That is the difference between gambling and investing. Gambling is reacting to price movement. Investing is understanding what you own, why it matters, how it makes money, how it survives a bad environment, and what it can become when the environment improves. This is why I would not simply chase oil. When oil goes up, many people say buy oil that can work for a period of time. Oil can go up for 3 months, 6 months, maybe a year. But if your objective is to build wealth over 10, 15, or 20 years, chasing the commodity itself is not the same as building a durable portfolio. Oil is cyclical, it moves up, it moves down, it responds to supply, demand, war inventory, policy, and expectations. In extreme situations, it can go very high. In weak environments, it can go very low. That is what cyclicals do. If you are a trader, you can trade that. But if you are building a long-term portfolio, you need to think differently. Going entirely to cash is also not a real solution. Cash feels safe during a crash, and there are times when holding cash gives you optionality. But if you sit in cash for long periods, inflation quietly destroys your purchasing power. You do not see the loss on a brokerage statement every day, but the loss is real. The same dollar buys less food, less energy, less healthcare, less housing, less life. That is why crashes are not usually what destroy long-term portfolios. Inflation does, bad behavior does, panic does, leverage does, impatience does, the market can fall and still recover. A great business can decline temporarily and still compound. But if you sell everything in fear, or use debt, or chase whatever is moving, or hold cash for decades because you never feel safe, you can permanently damage your financial life. This is the part many people get backwards. They think the danger is volatility, but volatility is often the price you pay for long-term returns. The bigger danger is buying weak companies, holding assets that cannot protect you from inflation, or making emotional decisions when the system is under stress. So when I think about the Iran shock and the possible market reaction, I do not think, how do I avoid all pain? That is impossible, I think. How do I build a portfolio that can live through the pain? How do I hold companies that matter more after the crisis than before it? How do I prepare cash and discipline so that if good assets are marked down, I can buy gradually instead of freeze emotionally? That is a much better question. The first area I look at is reliable power. You cannot understand the next decade without understanding power. Artificial intelligence is not just a software story, it is an energy story. Data centers do not run on narratives, they run on electricity. Models do not train on enthusiasm, they train on infrastructure. The more complex AI becomes, the more power it needs. In a stable world, that is already a major issue. In a chaotic world, it becomes even more important. If oil prices rise, if grids are stressed, if geopolitical uncertainty makes energy supply less reliable, the companies that provide reliable power, cooling, and on-site production become strategically more important. That is why I pay attention to companies tied to nuclear cooling and distributed power. A company like Camco, which is tied to nuclear fuel, sits in a category that becomes more important when the world needs reliable baseload power. A company like Vertiv, which is tied to the cooling and power infrastructure around data centers, sits in the picks and shovels layer of the AI build-out. A company like Bloom Energy, which focuses on on-site power production, speaks to a world where businesses want more control over energy reliability and less dependence on a stressed grid. I am not saying any stock is risk-free, nothing is. I am saying the category matters. When I think in systems, I ask what constraint the world is running into. In the AI cycle, one of the big constraints is power. If that is true, then the companies that help solve power constraints have a structural tailwind. That does not mean you buy blindly at any price. Price always matters. Valuation always matters. Risk always matters. But the starting point is to understand the bottleneck. The second area is memory. This is less obvious to many people. But it matters. As AI becomes more complex, it needs more context, more memory, more data movement, and more specialized hardware support. The world focused first on GPUs because GPUs were the visible bottleneck. But as systems become more advanced, memory becomes another bottleneck. When a bottleneck appears in a critical technology cycle, the suppliers who control that bottleneck can have enormous pricing power and demand. In memory, the market is concentrated. The major players dominate a large share of the industry. Building new supply is not quick. It takes years, capital, expertise, and execution. That is why I pay attention to Micron. It is a US-centered memory company tied to high bandwidth memory, which is the kind of memory AI data centers need. The thesis is not that the stock will go up every week. It will not. The thesis is that if AI demand continues to become more memory intensive, the companies positioned in that bottleneck can become much more valuable. Over time, again, the key is not to chase headlines. The key is to understand the cause and effect. More complex AI creates more memory demand. More memory demand creates pressure on supply. Concentrated supply creates potential pricing and profit opportunities. That is the chain. The third area is production. The world talks a lot about AI applications, but applications sit on top of production. Without chips, lithography, manufacturing, design software, and connectivity, the AI cycle cannot scale. That is why I look at the production layer. NVIDIA and AMD address the GPU problem. ASML produces lithography machines, the machines that make advanced semiconductor manufacturing possible. TSMC manufactures the chips at scale. ARM and Cadence sit in the design and software layer. Astra Labs sits closer to the connectivity layer that helps data move efficiently inside the AI infrastructure stack. These companies are different from each other, but they all share one important characteristic. They are part of the production system behind the modern technology economy. In ordinary times, production capacity matters. In chaotic times, it matters even more. When geopolitical tension rises, when supply chains become uncertain, when governments and corporations become more concerned about resilience, the companies that enable critical production become more valuable strategically. This is why I do not look at a crisis only through the lens of what falls today. I look at what the crisis reveals. A crisis reveals dependencies. It reveals which systems are fragile. It reveals which suppliers are irreplaceable. It reveals where the world has underinvested. It reveals which companies are optional and which companies are necessary. That is how you separate noise from signal. The fourth area is decision-making infrastructure. In a chaotic world, the value of better decisions rises. If you are running a government, a military, a supply chain, a hospital system, a bank, or a large corporation, and the environment becomes more uncertain, you need to see your data, understand your options, and act quickly. That is why a company like Palantir has been so powerful as a concept. Its role is to help institutions make decisions in complex environments. It connects data to action. It helps organizations operate when uncertainty is high. That is also why cybersecurity matters when the world becomes more digital and more chaotic. Attacks increase, vulnerabilities become more costly. The companies protecting digital systems become more important. A company like CrowdStrike sits in that category. Then there are the visibility and data layers, companies like Datadog and MongoDB. There are database and cloud layers, companies like Oracle, Microsoft, Google, and Amazon. These are not all the same business, but they share a broad function. They help organizations operate in a world where data, software, security, and cloud infrastructure are mission critical. That is a very important phrase, mission critical. When I evaluate a business for a difficult environment, I ask whether the customer can delay spending without consequence. If the answer is yes, the business may be fragile. If the answer is no, the business may be more resilient. A nice-to-have product gets cut in a crisis. A mission-critical system survives. The fifth area is automation and real-world productivity. When costs rise and uncertainty rises, the world searches for productivity. That is not a theory. It is what businesses must do. If labor is expensive, if energy is expensive, if financing is expensive, if supply chains are unstable, companies need tools that help them do more with less. That is why automation matters. Tesla is tied to autonomy and robotics. Meta is tied to advertising efficiency. Amazon combines cloud infrastructure with retail scale and logistics data. SoFi represents a kind of financial platform that benefits from the digitization of consumer finance. Robinhood, in a different way, speaks to how financial access and trading behavior have changed. These businesses are not interchangeable. Some are more volatile than others, some have stronger moats, some carry more execution risk, but the broad theme is productivity. In a difficult world, the companies that help people and businesses become more productive can still matter. That is why when I think about the next decade, I do not want a portfolio built only around fear. I want a portfolio built around necessity. Power is necessary, memory is necessary, production is necessary, decision infrastructure is necessary, cybersecurity is necessary, cloud and data are necessary, automation and productivity are necessary. That is the structure I care about. But having the right companies is not enough. Many investors lose money in good companies because they have a bad system. They buy too much too fast, they use margin, they panic when prices fall, they run out of cash, they confuse a temporary drawdown with a broken thesis, they fall in love with a story and stop looking at the numbers. Or they buy because someone else told them to buy and never build their own understanding. That is not investing. That is dependency. A good system starts with humility. You do not know where the bottom is. I do not know where the bottom is. Nobody knows where the bottom is. So if you think you can deploy all your cash at exactly the lowest price, you are fooling yourself. The better approach is to build slowly. Dollar cost averaging is not glamorous, but it solves a real behavioral problem. It keeps you from needing perfect timing. It allows you to buy through volatility. It gives you a process when emotions are trying to take control. But even dollar cost averaging needs discipline. You do not double down on everything. You do not average into weak businesses simply because they are cheaper. You average into businesses where the long-term thesis remains intact, where the financials support the story, where the company has the ability to survive the cycle, and where the position size does not threaten your portfolio. That last point is very important. Position size is a form of truth. If a position is so large that a drawdown makes you irrational, it is too large. If a stock falling 30% forces you to sell in fear, you either do not understand the business or you own too much of it, or both. The goal is not to avoid discomfort. The goal is to avoid decisions that permanently hurt you. That is why I would keep a core in broad market exposure, such as the S&P 500, rather than believing I can outperform only through individual stocks. Many investors overestimate their ability to pick winners and underestimate the discipline required to hold them. A broad market core gives you balance. It keeps you from making every decision dependent on a small number of companies. It lets you participate in the long-term rise of productive businesses across the economy. Individual stocks can then sit around that core, but they should not become a casino. No margin, no lending against positions, no panic buying because something fell for 2 days, no all-in decisions because a headline feels dramatic. Buy slowly, think in probabilities, keep enough liquidity to live through a long process. The market does not owe you a quick recovery. Sometimes the recovery comes fast. Sometimes it takes time. Sometimes the market falls, rallies, falls again, and tests your conviction repeatedly. That is why the system matters more than the prediction. Now let me come back to the biggest lesson, because it is the lesson most investors learn only after losing money. The headline is not the story. Iran is not the whole story. Oil is not the whole story. The Federal Reserve is not the whole story. The story is the system. If oil rises, inflation pressure rises. If inflation pressure rises, the Fed has less room to ease. If the Fed has less room to ease, financial conditions stay tighter. If financial conditions stay tighter, weak businesses struggle. If weak businesses struggle, markets reprice risk. If markets reprice risk, good businesses may get sold, along with bad businesses. If good businesses get sold for reasons that do not damage their long-term earning power, disciplined investors get opportunity. That is the chain. Most people cannot hold that chain in their heads. They react to the last link, they see the price falling and think the world is ending. A better investor studies the whole chain. The same is true on the upside. If a company's revenue keeps growing, if its gross margins improve, if its operating margins expand, if its net income grows, if its cash flow strengthens, then over long periods the stock price tends to follow the business. Not every week, not every month, but over time. That is why I pay attention to revenue and margins more than noise. People will always have objections. The PE is high. Insiders are selling. Competition is coming. The government exposure is too large. The government exposure is too small. The story is too popular. The story is too hated. There will always be arguments on both sides. But if the business keeps improving its revenues, margins, earnings power, and strategic position, then the fundamental engine is still working. That is what mattered for many great companies after previous crashes. Amazon was hit hard in the dot-com crash. It was hit again later. But the business survived and grew. Survival was the key. The company did not just survive as a stock symbol. It survived as a business model, strengthened, scaled, and compounded. That is what you are looking for in a crisis. Not the stock that avoids all declines. The business that can survive the decline and become more valuable after it. That is a completely different mindset. A weak company falling 70% may be a trap. A strong company falling 40% because the market is liquidating everything may be a gift. The difference is not the price decline. The difference is the business. That is why fundamentals matter, revenue matters, gross margin matters, operating margin matters, net income matters, cash flow matters, balance sheet strength matters, market position matters, strategic necessity matters. These things are not exciting on social media, but they determine the long-term outcome. The reason I am not emotionally shaken by every geopolitical shock is not because I think shocks do not matter. They matter a lot. The reason is that I have seen how the system behaves. Bull markets tend to last longer than bear markets. Expansions tend to create more value than contractions. Destroy for those who can survive. The world does not stop because there is a war. The world does not stop because there is a pandemic. The world does not stop because there is a recession. People still need energy. They still need computing. They still need security. They still need infrastructure. They still need productivity. They still need financial systems. They still need tools to make decisions under uncertainty. The world keeps adapting. Companies that help the world adapt can become very valuable. But you have to be there when it is uncomfortable. You have to prepare before the fear arrives. You have to decide what you want to own before the price is collapsing and your emotions are screaming at you. That is why a shopping list matters. Not a list of tips, a list of businesses you understand, a list of themes that fit the world you see, a list of companies that solve real constraints, a list of prices and position sizes you are willing to act on gradually. That list should not be built during panic. It should be built before panic. When the market is calm, you think clearly. When the market is collapsing, you execute the plan. This is how I would think about the moment we are entering. I would not assume the Iran shock will be small. I would not assume it will become catastrophic. I would map the probabilities. If oil keeps rising, inflation pressure increases. If inflation pressure increases, rate cuts become harder. If rate cuts become harder, valuations may compress. If valuations compress, even strong companies may fall. If strong companies fall while their long-term thesis remains intact, I want to be ready. That readiness is not emotional excitement. It is preparation. There is a big difference. Excitement makes people reckless. Preparation makes people calm. The goal is calm. Calm does not mean passive. It means clear. You know what you own. You know why you own it. You know what would make you buy more. You know what would make you change your mind. You know what position size lets you sleep. You know what your time horizon is. Without that, every headline becomes a threat. With that, a headline becomes data. This is the difference between a principle-driven investor and a reaction-driven investor. A reaction-driven investor says oil is up. What should I buy today? A principle-driven investor says oil is up. What chain of consequences does that create, and which durable businesses become more important over time? A reaction-driven investor says, the market is down, should I sell? A principle-driven investor says, has the long-term earning power of what I own changed, or has only the price changed? A reaction-driven investor says, I want to make money from the crisis. A principle-driven investor says, I want to survive the crisis, preserve capital, and buy durable assets gradually when fear creates mispricing. That is how I would approach it. So if you are thinking about the next 10 years, do not make the mistake of building a portfolio for last year's world. The next decade may be defined by energy constraints, AI infrastructure, memory shortages, chip production, cybersecurity, cloud, automation, and geopolitical uncertainty. It may be defined by higher volatility. It may be defined by inflation that does not disappear as quickly as people hope. It may be defined by governments and corporations trying to secure critical systems. In that world, you want to own companies that sit close to necessity. Not every company in these categories will win. Some will disappoint. Some will be too expensive. Some will execute poorly. That is why you diversify. That is why you size positions carefully. That is why you keep a broad market core. That is why you do not borrow money to invest. That is why you do not confuse a thesis with certainty. But the direction of thinking is right. Look for bottlenecks. Look for mission, critical infrastructure. Look for strong margins. Look for revenue growth. Look for companies that become more useful when the world becomes more complex. Look for businesses that can survive stress. And then build a system that allows you to hold them, because the biggest problem for most investors is not that they never find good companies. It is that they cannot hold them through the conditions that create the best returns. They buy when everything feels safe and expensive. They sell when everything feels dangerous and cheap. They repeat that cycle for decades and then blame the market. But the market is not the enemy. The market is a mechanism that transfers assets from the impatient to the patient, from the over-leveraged to the liquid, from the emotional to the prepared. That is a harsh truth, but it is useful. If the coming shock creates a sell-off, it will not be evenly distributed. Some companies will fall because their business is truly impaired. Others will fall because liquidity disappears and investors sell whatever they can sell. Your job is to know the difference. If a company depends on cheap capital and weak demand exposes the business model. Be careful. If a company has strong demand, strong margins, critical products, and long-term relevance, a decline may be an opportunity. That is the basic decision, but do not turn it into a slogan. Do the work, study the financials, study the margin trend, study revenue quality, study the balance sheet, study whether the product is mission critical, study the competitive position, study the valuation, then build slowly. This is not about predicting the next candle on a chart. It is about positioning for the next cycle. And cycles reward people who understand that pain and opportunity often arrive together. When everyone is bullish, risk is usually rising because prices already reflect optimism. When everyone is bearish, future returns may be improving because prices already reflect fear. That does not mean you buy everything in a crash. It means you become more interested when fear is high and more careful when enthusiasm is extreme. That is a simple principle, but it is difficult to live by. The reason it is difficult is that human beings are wired to seek safety in crowds. When everybody sells, selling feels safe. When everybody buys, buying feels safe. But markets do not reward comfort. Markets reward independent thinking, patience, and the ability to act when the crowd is emotionally compromised. That is why you need rules before the event. You need to know that you will not use margin. You need to know that you will keep a core position in broad market exposure. You need to know that you will buy gradually. You need to know that you will not panic because a great company falls with the market. You need to know that you will not double down on a broken thesis. You need to know that you will judge the business by the business, not by the noise. If you can do that, a crisis becomes different. It is still uncomfortable, it still creates losses, it still tests you, but it does not control you. The Iran shock, if it becomes a major market event, will create fear because it hits the parts of the system people already worry about. Energy inflation rates, growth, consumer pressure, corporate margins. It is a shock to a fragile environment. That is why it matters. But I want you to understand something clearly. The existence of risk does not mean you run away from all assets. It means you become more thoughtful about which assets you own and how you own them. The long-term wealth opportunity is not in predicting the war. It is in understanding which businesses the world will still need after the war, after the oil spike, after the rate debate, after the panic, after the forced selling. That is where the real thinking is. When I look at the list of companies tied to power, memory production, decision systems, cloud, cybersecurity, and automation, I am not looking for a one-week trade. I am looking for structural relevance. Camco, Vertiv, Bloom Energy, Micron, NVIDIA, AMD, ASML, TSMC, Arkansas M, Cadence, Astra Labs, Palantir, CrowdStrike, Datadog, MongoDB, Oracle, Microsoft, Google, Amazon, Tesla, Meta, SoFi, Robinhood. Each name has different risks. Each name has different valuation issues. Each name must be studied separately. But together, they point to the same idea: the next decade will likely reward companies that provide the infrastructure, intelligence, security, power production, and productivity required to function in a more chaotic world. That is the core idea. Do not let the drama of the moment make you forget the structure underneath it. Oil shocks come and go, political headlines change, market drawdowns hurt and then pass. But the long-term compounding of great businesses is what changes financial lives. The opportunity is not to be fearless. Fearlessness is often stupidity. The opportunity is to be principled, to know that fear will come and still have a plan, to know that prices will fall and still understand the difference between price and value, to know that the crowd will panic and still follow your process, to know that inflation is the real enemy of idle money, to know that leverage can turn volatility into ruin, to know that the best companies can be marked down in the worst moments, and to know that your job is not to predict perfectly but to prepare intelligently. That is what I would do. I would prepare my watch list. I would keep my broad market core. I would avoid margin. I would buy slowly. I would focus on businesses that solve real constraints. I would study revenues and margins, not just stories. I would use volatility as a tool, not let it use me. And I would remember that every generation faces a version of the same test. The test is never exactly the same on the surface. It might be oil, it might be war, it might be inflation, it might be credit, it might be technology. But underneath, the test is always the same. Can you stay rational when others become emotional? Can you think in cycles when others think in headlines? Can you buy quality when fear makes quality cheaper? Can you hold strong businesses through temporary pain? Can you avoid the behaviors that turn temporary volatility into permanent loss? If you can do that, the coming shock does not have to wipe you out. It can become a moment that improves your portfolio for the next decade. Not because crisis is good. Crisis is never good for the people living through it, but because markets in crisis often misprice the future. And if you can see the future more clearly than the frightened crowd, if you can separate fragile companies from durable ones, if you can act slowly and rationally while others are forced to act quickly and emotionally, then the same event that destroys weak hands can create enormous opportunity for disciplined investors. That is the lesson. Do not chase the panic. Do not worship the headline. Do not hide in cash forever. Do not borrow to buy. Do not pretend you can call the bottom. Do not confuse volatility with risk. Do not confuse popularity with quality. Look through the shock, look through the oil spike, look through the fear, look at the system, look at the bottlenecks, look at the businesses that will matter more when the dust settles. Then act with discipline. That is how you protect yourself. That is how you position yourself. And that is how a difficult decade can become a wealth building decade for the people who are prepared before the opportunity arrives.